Hello, everybody. Welcome to Clever Investments. Starting today, let's talk about forward call and why I think it is not a good trading strategy. So I'll spend several videos to discuss it. And let's start with how covered call works. So first, you need to have some stock in your account. And then you can sell calls against your stock. So for example, if you have 100 shares of stock, you sell one call contract. And you need to sell out of the money call, which means the strike price of the call is higher than the current stock price. And when you sell the call, you take some premium because the call worth some money, and there's a chance that the call expires. So there's a trade-off. If the strike is very high, the chance of expiring is low, but the premium is also low, which means you get less money and the chance that you lose money on the call is less. If you sell a lower strike, which is slightly higher than stock price, then you get a lot more premium, but then if the stock goes up, you lose money on the call. And also, you need to choose the expiration date. So a monthly call is a popular choice for covered call. So every month, you sell a call that expire the next month. And you hope the call expires because if the stock price doesn't rise fast enough, then on the expiration date, the stock price would be less than the strike price of your call. And then the call would expire worthless and you take all the premium. So that's the idea of the call. And then when the call expires, you sell another call next month. So then you continue to do this. So if the stock price goes up too quickly, the call becomes in the money. So it will worth a lot more than the premium you get. So in this case, you have to solve it. The preferred way is to buy the call back at a higher price. So you lose money on the call. But because the stock price goes up, so your stock has provided more value. So you actually made some money, although you lose money on the call. But because you need to buy the call back at a loss, you need more money. So that means you may need to sell some stock so that you have enough money to buy the call back. And I think this is a better method than the alternative, where in the alternative, you do nothing, you let the call expire, and then you will be assigned and you will be forced to sell the stock at the strike price of the call. Then all your stock is gone and you're left with lots of cash in your account. And then you can buy stock back at the current price, which is higher. But because the price is higher, you likely get less shares than before. So this method is not as good as the preferred method because once you sell all the stock, if the cost basis of the stock is low, you pay capital gain tax, which is not good. But if you use a previous method, you buy the call back, you get a capital loss because you lose money on the call. And since you didn't sell the stock, so there's no capital gain realized on the stock, which is more tax friendly. So the covered call has many apparent benefits. It's a popular and easy strategy because many people already have some stock in their account. And if they can sell calls, then they can get monthly income, which sounds very nice. And it's also very comfortable because most of the calls would expire worthless. So this looks like free income. So you're taking in free income every month. For example, if you sell the call and get 1% of your portfolio account value every month, then that means every year you could get 12% of additional income. And this itself may be much higher than the gain of the stock if you didn't pick a good stock. But is this really a good strategy? I don't think so. And the first, there's a small problem is it's not tax efficient. This is because every month when the call expires, it generates capital gain if you are making money. And capital gain has a very high rate in California. So this rate is for long-term capital gain. And every month when you sell the call, you get short-term capital gain, which is even worse. You may need to pay more than half of the tax. Okay, so in next video, we will talk about more problems, more fundamental problems of covered call and why it is a very bad trading strategy. Okay, see you next time. Thanks.